Thank you so much for updating on all that, and of course break in as you get some details on the Citigroup conference call with a closer look on all of this situation. I'm joined by Dennis Berman. He's the Deputy Bureau Chief of the Wall Street Journal for Money and Investing. Leo Tillman is the president of the advisory firm LM Tillman and author of Financial Darwinism. And Ramesh Menon is the founder and president of Structured Investment Management and the former managing director of Structured Products at Citigroup. Okay, I have stacks of paper here because we now need to forget all the details of all the earnings. I've become a financial accountant. And now we need to deal with the cleaning up the mess, Dennis. And this mess between Bank of America and Merrill Lynch, dilutive for 2 years.
This looks like a very bad deal. You can't say it any other way. John Thain, as he was going into the deal, and Ken Lewis, as he was going into the deal, said, oh, you know, we've got everything under control here at Merrill Lynch. The balance sheet looks perhaps better than it was a while ago. This is going to be a great combining of the Merrill Thundering Herd and the B of A culture. And so far, you've seen defections from the Merrill Lynch senior ranks. You've seen huge losses come out of Merrill, and you've seen Ken Lewis say, my earnings are going to be shot for 2 years. So a deal from hell is what we like to call these. Maybe we could put them next to Time Warner AOL right now.
Yeah, I mean, you know, it's amazing to me, Leo. I was talking about this with somebody yesterday who was outraged about the TARP funds and the fact that the government keeps backstopping these assets, who said it's like rejiggering the chairs on the deck of the Titanic. I mean, that's all we've in essence done. We still have lots of crap in all of these banks, or I shouldn't say lots of poor assets in all of these banks, and the bottom line is we're just reshuffling them in different places.
Well, I think one of the problems is what we complained before, that people are using TARP money to create acquisitions and capture market shares that they plan to do for a long, long time, which is really inappropriate because the TARP is there to stimulate the economy and save certain vital institutions. Secondly, I think it illustrates yet another point that came up in the acquisition by Wachovia of Golden West and others, where executives make decisions based on considerations that are not based in risk, things like market shares and new businesses and things like that. And they're so focused on that part of the equation that they completely disregard the risks involved in these transactions. It comes over and over again.
One of the things, Ramesh, that President-elect Obama and Lawrence Summers had to agree to yesterday for getting approval of the remaining TARP funds is that the funds will no longer be used for any mergers and acquisitions. How does that perhaps change the ball game if, in fact, there are things going on at other financial institutions that either we're not aware of or on the cusp of some dire straits?
Well, I think it changes the ball game entirely as the CEO of a company that's the recipient of TARP funds, unless there is a constraint put on the use of those funds, acting in shareholder interest. Obviously, what I would want to do is to go out and make strategic acquisitions. So to the extent that that isn't possible any longer, and to the extent that the interest isn't there, then there needs to be a corporate government mechanism that restricts the conduct of such behavior. And the mechanism isn't currently in place. So now essentially what you have is conflicted leadership. You know, essentially what I would describe as I've said once before, you know, the visually impaired leading the mentally challenged. I mean, that essentially is the circumstance.
But it does seem a bit odd, Alexis, to say, oh, you can't use the money for this.
How are they going to do that, Dennis?
We see right there is where we see the conflict between government and private enterprise, because in some cases it might make perfect sense for there to be an M&A deal. In fact, the government itself has insisted that certain banks acquire weaker banks to make sure that banks don't fail.
And as the taxpayer, if there is an opportunity for a strong bank to buy a strong bank that's under dire straits, but to take advantage of the right pricing parameters, that may actually be good for us as shareholders.
Right. Absolutely, and I think we need to sort of revisit the purpose of that. The purpose is to stimulate the economy and save vital institutions. So if in any particular case saving an institution means a strategic acquisition that we all believe is going to stimulate the economy, like WAMU, yeah, that it makes sense. But in other cases where people are simply capturing market shares and advancing completely other considerations while ignoring risk, that's unacceptable.
What happens from here, Ramesh? Let's just look at the Citigroup situation. They announced what many people speculated. They announced the beginning of a restructuring here. Can they get themselves to a healthy place under this restructuring model?
The only thing that is going on here is a very controlled slide into bankruptcy at the holding company level. What they're doing is unwinding the company piece by piece as they can without any grandeur business strategy. Eventually, there will be nothing left but the U.S. bank. The FDIC will have to come in and resolve the U.S. bank, extract it from the Citigroup corporate structure, and the holding company will declare bankruptcy. So to the extent the stock is at $3.75 or $4, then it's $4 higher than it needs to be.
Well, that's a pretty strong point of view here.
Wow.
I mean, let's think about what the TARP is supposed to do. The TARP is, whether by design or by not, by fiat, it's become sort of a bankruptcy prevention vehicle for a lot of banks. And to have people talk about Citigroup in that manner is, I don't know, perhaps a destabilizing force. Now, it may well be that we don't know where it's going, but we have to think about what is the least worst scenario. And there are so many problems with TARP and so many problems with the way this whole rescue plan has been designed. But we could say probably that the alternative scenario without doing that would be far worse. So it's very easy to criticize, but we need to recognize
Dennis,
that.
Let's be fair about it. By separating Citicorp and Citi Holdings, now Citi Holdings will have the toxic assets. It also has their asset management business, which has been considered the crown jewel, particularly given what's been happening in this current climate. Perhaps you wouldn't have considered maybe a crown jewel years ago. Now you're considering more and more of a crown jewel. So it's not as though they've created a good, bad bank structure. I think in some regard what they've done, Dennis, is people don't understand this company. It's so complicated to get in the meat of it. And now they're creating a corporate structure that maybe people can understand.
Maybe. It's just cosmetic, though, because the shareholders aren't getting different shares in different companies. It's like those old tracking stocks from the internet days. We're going to highlight this asset because it's really good.
Still the same bank holding company.
It's still the same thing.
All right, Leo, let's move to the Bank of America case and get into this Ken Lewis thing. Ken Lewis said on the conference call just moments ago the losses were far worse than even he expected. How do they figure out how to integrate these two companies when it is the bad blood is outrageous?
Well, I think it raises a bigger point that the lack of risk-based transparency, the fact that you don't know what risks financial institutions are exposed to when you're trading or investing in them, is manifesting itself in this transaction. Because in one weekend, it's simply impossible to go into a company like Merrill Lynch and evaluate all of these assets. And it's so puzzling how people looked at Lehman and said, oh, no, I'm not buying you, but I'm buying you because you're simpler and more valuable. It's just not possible to figure these things out. Therefore, I think people are focusing on business considerations, market shares, corporate finance decisions, and sort of ignoring the risk. And it takes this much to come out.
It's not even like getting married after a first date. It's like getting married after you see someone's online profile. You haven't even met them. So 48 hours of due diligence is really that equivalent.
And Ramesh, I imagine that Ken Lewis said, listen, you pulled me into a closed-door meeting on the weekend that Lehman Brothers was going to fail. Merrill Lynch could have been the next to fail. You told me to step up, get a deal done before I walked in on Monday morning, and I'm not going to go through with this deal now that I know what's behind it unless you step up to the plate.
Absolutely, and I can understand his point of view.
All right. Oh, that's a great way to leave it.
And now we have to deal with it.
Now we got to digest it. There's a good thing that the FDIC is backstopping our deposits because that makes me feel good. Let's not forget, people, that only 23 banks failed in 2008, and during the S&L crisis, about 2,800. So, maybe we live for another day.
We're all much tinier. The plane landing was such a miracle, such a nice thing.
Wasn't that a nice, that plane landing, I'm so happy because it puts everything in context. We need to, rearrange the deck. All right, Leo, Dennis, and Ramesh, thank you very much.